School of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 4 Dividend Decisions, Unit 13 Dividend Policies. After completing this unit, you will be able to discuss the various forms of dividend, identify the factors affecting the dividend decisions, and explain the different types of dividend policies followed by the companies. Introduction. A business organization always aims at earning profits. The utilization of profits earned is a significant financial decision. The main issue here is whether the profits should be used by the owners or retained and reinvested in the business itself. This decision does not involve any problem insofar as the sole proprietary business and partnership concerns. Since the company is an artificial person, the decision regarding utilization of profits rests with a group of people, viz. The board of directors. As in any other types of organizations, the disposal of net earnings of a company involves either their retention in the business or their distribution to the owners in the form of dividend or both. Therefore, the decision-making is somewhat complex in the case of joint stock companies. In case of a company, the decision regarding dividend is taken by the board of directors and is then recommended to the shareholders for their formal approval in the annual general meeting of the company. The disposal of profits in the form of dividends can become a controversial issue because of conflicting interests of various parties like the directors, employees, shareholders, debenture holders, lending institutions, etc. Even among the shareholders, there may be conflicts as they may belong to different income groups. While some may be interested in regular income, others may be interested in capital appreciation and capital gains. Hence, formulation of dividend policy is a complex decision which needs careful consideration of various factors. One thing, however, stands out. Instead of an ad hoc approach, it is desirable to follow a reasonably long-term stable policy regarding dividends. In the previous unit, you must have been made aware of the relevance and irrelevance of the dividend decision in the determination of the value of a firm. In this context, different theories were proposed under a set of assumptions. Given the imperfections prevailing in the real world, a company cannot treat its dividend policy irrelevant. It must carefully analyze the environment in which it is operating and take into consideration various factors that have a bearing on its valuation. Now, after realizing the importance of dividend policy, this unit covers the important dimensions of dividend policy, discusses the factors relevant for formulating the dividend policy, and policy relating to stock split, bonus issues, stock repurchase, etc. Forms of dividend. Dividend is a distribution of profits earned by a joint stock company among its shareholders. Mostly dividends are paid in cash, but there are also other forms such as scrip dividends, debenture dividends, stock dividends, and in unusual circumstances, property dividends. Let's discuss them briefly. Stock dividend or bonus shares. Instead of paying dividends out of accumulated reserves, the latter may be capitalized by issue of bonus shares to the shareholders. Thus, while the funds continue to remain with the company, the shareholders acquire the right and this way their marketable equity increases. They can either retain their bonus shares and thus be entitled to increased total dividend in future or can sell their bonus shares and realize cash. Ordinarily, bonus shares are not issued in lieu of dividends. They are periodically issued by the prosperous companies in addition to usual dividends. Certain guidelines, as laid down by the Companies Act 2013, are applicable for issue of bonus shares in India. Number 2. Stock splits. A method of either increasing or decreasing by a reverse split the number of shares outstanding and thereby proportionately lowering or raising the market price per share is called stock split. If a company believes that its share is priced too high and that lowering the market price will enhance trading activity, one equity share is divided into 2 or more shares. For example, before stock split, let's say common stock of 2 lakh shares with rupees 10 par value is equal to rupees 2 lakh. And after stock split, common stock of 4 lakh shares with a rupees 5 par value is equal to rupees 2 lakh. The stock split has no effect on capital structure. It increases the number of shares and reduces stock's par value. The stock splits are made generally prior to new issue of stock to enhance the marketability of the stock and stimulate the market activity. Number 3. Stock repurchases or buyback. Companies repurchase their stock to change their capital structure or to increase the returns to the owners. Companies with exceptionally good liquid position, which do not have attractive investment opportunities, buy back their shares. A company can buy back its stock from the existing shareholders on a proportionate basis through the tender offer from open market through number 1. Book building process or number 2. Stock exchange and from odd lot holders. Number 4. Property dividends. A company may issue a non-monetary dividend to investors rather than making a cash or stock payment. This form of dividend is unusual and such dividend may be in the form of inventory or securities in lieu of cash payment. A company sometimes may hold shares of other companies. For example, its subsidiaries that it may like to distribute among its own shareholders instead of paying dividend in cash. In case the company sells these shares, it may have to pay capital gains, which may be subjected to taxation. If these shares are transferred to its shareholders, there is no tax liability. Number 5. Debenture dividends. The companies may also issue debentures in lieu of dividends to their shareholders. These debentures bear interest and are payable after a prescribed period. It is just like creating a long-term debt. This is not a common practice. Number 6. Scrip dividends. A company may not have sufficient funds to issue dividends in the near future. In such a situation, it issues a scrip dividend. The dividends can be paid only out of profits earned in the particular year or in the past reflected in the company's accumulated reserves. The profits do not necessarily mean adequate cash to enable payment of cash dividends. In case the company does not have a comfortable cash position, it may issue promissory notes payable in a few months. It may also issue convertible dividend warrants redeemable in a few years. And last is liquidating dividends. When the board of directors wishes to return the capital originally contributed by shareholders as a dividend, it is called a liquidating dividend and may be a precursor to shutting down of the business. The accounting for a liquidating dividend is like the entries for a cash dividend, except that the funds are considered to come from the additional paid-in capital account. Factors affecting dividend decisions. The factors affecting dividend policy can be grouped into 2 broad categories. Number 1, ownership considerations, and number 2, firm-oriented considerations. Ownership considerations. Where the ownership is concentrated in few people, there are no problems in identifying ownership interests. However, where ownership is largely spread on a wide spectrum, the identification of their interests becomes difficult. Further, the influence of stockholders' interest on dividend decision becomes uncertain because, number 1, the status or preferences of stockholders relating to their position, capital gains, current income, etc. cannot be precisely ascertained. And number 2, a conflict in shareholders' interest may arise. In spite of these difficulties, efforts should be made to ascertain certain interests of shareholders to encourage market acceptance of the stock. They are: number 1, current income requirements of stockholders; number 2, alternative use of funds in the hands of stockholders; and number 3, tax matters affecting stockholders. Since different groups of shareholders may have various desires and objectives, understandably, investors gravitate to those companies that combine the mix of growth and desired dividends. Since companies generally do not have a singular group of shareholders, the objective of the maximization of the market value of shares requires that the dividend policy be geared to investors in general. Firm-oriented considerations. The ownership interest alone may not determine the dividend policy. A firm's needs are also an important consideration, which include: number 1, contractual and legal restrictions; number 2, liquidity, credit standing, and working capital needs; number 3, dividend decisions; number 4, need of funds for immediate or future expansion; number 5, availability of external capital; number 6, risk of losing control of organization; number 7, relative cost of external funds; number 8, business cycles; and number 9, post-dividend policies and stockholder relationships. Determinants of dividend policy. The dividend policy determines the distribution of earnings available to shareholders or earnings per share between dividend payment and retention. The earnings per share is equal to dividend per share plus retention per share. This breakup must be carefully decided, keeping in view of several various factors which are divided into external and internal factors. External factors. The external factors are those factors which are uncontrollable and cannot be influenced by decisions of the management of the company. The finance manager has to adopt his policies. Whenever there is a change in these factors. They include: number 1, state of the economy. The general state of the economy in which the company operates has a great impact on dividend policy. If the economy is passing through boom or prosperity, all the businesses will be expanding, showing good financial results. Market price of shares rises rapidly. Companies need funds for expansion or diversification, and therefore many prefer to retain profits instead of approaching the capital market for funds. During the recession, business faced problems of contracting sales, mounting inventories, decreasing profits, etc. If the recession persists, businesses must cut down the production capacities. The market price of the companies continues to fall, and the companies must make a logical balance between dividends and retentions to stabilize the market price. Number 2, state of the capital market. This is related to a company's access to the capital market. If the capital market is overwhelmingly in favor of equity issue, then the companies may adopt liberal dividend policy. At times when funds are required, companies access the capital market instead of generating internal funds through retention. Number 3, tax policy. If the dividends are taxable in the hands of the shareholders, as is the present case, shareholders in the highest tax bracket would prefer not to receive dividends. Instead, they would prefer to accrue the gains through capital gains, which are taxed at lower rates. But at the same time, shareholders in lower tax brackets or out of tax system would prefer dividends. Number 4, inflation. Inflation is also a factor which may affect a firm's dividend decision. During the inflation, funds generated from depreciation may not be adequate to replace worn-out equipment. Under these circumstances, the firm must depend on the retained earnings as a source of funds to make up for the shortfall. On account of inflation, often the profits of most of the companies are inflated. A higher payout ratio based on overstated profits may eventually lead to the liquidation of the company. Inflation has another dimension. In an inflationary situation, current income becomes more important and shareholders in general attach more value to current yield than to distant capital appreciation. They would thus expect a higher payout ratio. And lastly, requirements of institutional investors. The dividend policy of a company is affected by the requirements of institutional investors such as financial institutions, banks, insurance companies, mutual funds, etc. These investors usually favor a policy of regular payment of dividends. Internal factors. Internal factors are the factors that are within the control of the company. Companies can make changes in these factors and can design their dividend policy. Some of these factors are: number 1, nature of business. Any business enterprise engaged in the production with steady demand can follow a liberal dividend policy. There are various factors which are controllable by the companies with seasonal variations or cyclical variations in the demand for their product. These companies cannot follow liberal dividend policy. They adopt a cautious approach, which is an important determinant of the dividend policy of a company. The business firms with unstable earnings adopt dividend policies which are different from those of steady earnings. The consumer goods industries usually suffer less from uncertainties of income and therefore pay dividends with greater regularity than the capital goods industries. The public utilities may be able to establish a relatively fixed dividend rate. The mining companies, on the other hand, with long gestation period and multiplicity of hazards, may not be able to declare dividends for years. But once they get established, they might afford to make liberal dividend payments. If earnings fluctuate and losses are caused during depression, the continued payment of dividends may become a risky proposition. A healthy company with an eye on future follows a somewhat cautious policy and builds up reserves. A company which believes in publicity gimmicks may follow a more liberal dividend policy to its future detriment. A firm with a heavy program of investment in research and development would see to it that adequate reserves are built up for the purpose. Number 2, composition of the shareholders. The composition of shareholders influences current income requirements of shareholders. If the shareholders belong to low-income brackets or retired persons, the expectation for a regular dividend will be more, which influences the dividend policy. There may be marked variations in dividend policies on account of the variations in the composition of the shareholding. In the case of a closely held company, the personal objectives of the directors and of most of the shareholders may govern the decision. The widely held companies have scattered shareholders, and such companies may take the dividend decision with a greater sense of responsibility by adopting a more formal and scientific approach. The tax burden on business corporations is the determining factor in formulation of their dividend policies. The directors of a closely held company may take into consideration the effect of dividends upon the tax position of their important shareholders. Those in the high income brackets may be willing to sacrifice additional income in the form of dividends in favor of appreciation in the value of shares and capital gains. However, when the stock is widely held, stockholders are enthusiastic about collecting their dividends regularly and do not attach much importance to tax considerations. Thus, a company which is closely held by a few shareholders in the high income tax brackets is likely to pay out a relatively low dividend. The shareholders in such a company are interested in taking their income in the form of capital gains rather than in the form of dividends, which are subjected to higher personal income taxes. On the other hand, the shareholders of a large and widely held company may be interested in high dividend payout. Number 3, alternative uses of funds. If the shareholders have alternative uses of the funds, they will prefer the company to declare dividends so that they can invest the dividend amount in alternative opportunities. Many companies retain the earnings to facilitate planned expansion. The companies with low credit rating may feel that they may not be able to sell their securities for raising necessary finance they would need for future expansion. Hence, they may adopt a policy for retaining larger portion of earnings. In the context of opportunities for expansion and growth, it is wise to adopt a conservative dividend policy if the cost of capital involved in external financing is greater than the cost of internally generated funds. Similarly, if a company has lucrative opportunities for investing its funds and can earn a rate which is higher than its cost of capital, it may adopt a conservative dividend policy. Number 4. Control. If a company adopts a liberal dividend policy, it may have to access the capital market through a fresh issue of shares. This may dilute the control of the existing shareholders as the proportion of their shareholding decreases with every fresh issue of shares. If the existing shareholders do not like to dilute their control, they would prefer low dividend payout. The attitude of the management affects the dividend policies of a corporation in another way. The stockholders who control the management of the company may be interested in empire building. They may consider plowing back of earnings as the most effective technique for achieving their objectives of building up the corporation. Number 5. Desire for liquid funds. The dividend policy of a company is influenced by a company's need for liquid funds for meeting working capital requirements. It depends upon the credit standing of a company, which may desire to build up reserves by retaining their earnings. Therefore, business firms may consider it necessary to conserve their cash resources to face future emergencies. Cash credit limits, working capital needs, capital expenditure commitments, repayment of long-term debt, etc. influence the dividend decision. Companies sometimes prune the dividends when their liquidity declines. And lastly, other factors. Age of the company has some effect on the dividend decision. The well-established companies often find it easier to distribute earnings without causing an adverse effect on the financial position of the company than a comparatively younger ones which are yet to establish themselves. The demand for capital expenditure, money supply, etc. undergo great oscillations during the different stages of a business cycle. As a result, dividend policies may fluctuate from time to time. In many instances, dividend policies result from tradition, ignorance, and indifference rather than from considered judgment. An industry or a company may have established some satisfactory standard for the payment of dividends, and this standard becomes a convention or custom for that industry or company. Types of dividend policies. The objective of management of any company usually is the maximization of the market value of the enterprise, that is, its wealth. The market value of common stock of a company is influenced by its policy regarding allocation of net earnings into plowback and payout. While maximizing the market value of shares, the dividend policy should be so oriented as to satisfy the interests of the existing shareholders as well as to attract the potential investors. Thus, the aim should be to maximize the present value of future dividends and the appreciation in the market price of shares. In the previous sections of this unit, we have already discussed the various factors that influence the dividend policy of a company. Goals of dividend policy. There are several factors which influence the determination of the dividend policy. As such, no two companies may follow exactly similar dividend policies. The dividend policy must be tailored to the circumstances of the company. The aspects that have general applicability are: Number 1. Dividend policy should be analyzed in terms of its effect on the value of the company. Dividend, investment, and financing decisions are interdependent, and there is often a trade-off. Number 2. Dividend decision should not be treated as a short-run residual decision because variability of annual earnings may cause even a zero dividend in a particular year. This may have serious repercussions for the company and may result in the delisting of its shares for the purpose of dealing on any approved stock exchange. Number 3. Whatever dividend policy is adopted by the company, the general principles guiding the dividend policy should, as far as possible, be communicated clearly to investors who may then take their decisions in terms of their own preferences and needs. And number 4. Erratic and frequent changes in dividends should be avoided because the reduction in the rate of dividend is a painful thing for the shareholders to bear. The management will find it hard to convince the shareholders the desirability of a lower dividend for the sake of preserving their future interests. Dividend policy options. The dividend policy refers to the policy that the management formulates with respect to earnings for distribution as dividend among shareholders. It is not merely concerned with dividends to be paid in 1 year, but is concerned with the continuous course of action to be followed over a period of several years. Therefore, dividend decision involves dealing with several questions, such as number 1, whether dividend should be paid right from the initial year of operation, that is, regular dividends. Number 2, whether equal amount or a fixed percentage of dividend be paid every year, irrespective of the quantum of earnings, as in case of preference shares, that is, stable dividends. And number 3, whether a fixed percentage of total earnings be paid as dividend, which would mean varying amount of dividend per share every year, depending on the quantum of earnings and the number of ordinary shares in that year, that is a fixed payout ratio. Now let's summarize the unit. The dividend is a portion of the profits distributed to shareholders in a company and is usually expressed as a percentage of nominal value of shares. Dividends are often paid in cash, though in theory other forms also exist. The dividend policy involves the decisions whether to retain earnings in the firm for capital investment and other purposes, or to pay out the earnings in the form of cash dividend to shareholders. There are many financial managers who believe that a stable dividend policy with a certain percentage on paid-up capital and with periodic increases is a better course to follow. Besides being psychologically appealing, stable dividend also has an information content in that. It indicates to investors the management's expectation on levels of long-run earnings and growth. Often the company has to strike a balance between its own needs for funds for financial growth opportunities and the needs and expectations of the investors. In view of this, therefore, dividend policy cannot or should not be regarded as a residual policy. While it is true that companies with strong investment opportunities have relatively low dividend payout ratio and vice versa, most financial managers like to follow a stable dividend policy. There are several factors which impinge upon the dividend decision. The attitude and objectives of management, nature of business, composition of shareholdings, cash position, and future needs for funds are some of the important considerations which have a bearing on the dividend decision. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.